Okay, we will go ahead and get started here. So, good afternoon, everyone. My name is Derek Job. I am a team lead and financial advisor here at Apella Wealth. We are really glad you could join us today for our April edition of Apella Academy. So, before we get started, just a couple of quick housekeeping items. So, today's webinar is being recorded and we will be sharing a copy with you in the coming weeks. We will email it out, but we will also post it on the Apella Wealth website. And you can also find all of our past Apella Academy webinars on our website, apellawealth.com. So, feel free to revisit those or share them with friends, family, or colleagues who may find them helpful. Also, be sure to mark your calendars for our next session on May 20th, where we will be covering estate planning. So, during today's presentation, if you have any questions, please submit them using the Q&A box at the bottom of your screen, and we will plan to address as many of those questions as we can at the end of the presentation. So, now let's take a look at our topic today, which is behavioral finance and more specifically cognitive biases in investing. So, what are cognitive biases? Well, cognitive biases are the mental shortcuts our brains use to process information quickly. And unfortunately, in investing, these biases usually lead us in the wrong direction because the reality is in successful investing, it isn't just about picking the right investments, it's also about consistently making sound, correct decisions on a daily basis. So, to help us explore this topic, I'm joined by two excellent speakers. First, we will hear from my colleague, Penny Schmidt. Penny is a certified financial planner and senior financial advisor in our Johnston, Iowa office. And following Penny, we will hear from Seth Hoffman. Seth is a senior financial advisor based in our Lenox, Massachusetts office. Both Penny and Seth have several decades of experience in the industry, and we are very lucky to be hearing from them today. So, again, our goal during this webinar is to simplify complex topics, address common misconceptions, and help you walk away with a clearer understanding. So, again, quick reminder, if you have any questions, please submit them in the Q&A box at the bottom of the screen. And with that being said, Penny, I will kick it over to you.
Excellent. Thank you, Derek, and thank you everyone for joining us. I'm gonna let there we go. Awesome. Get that PowerPoint up. Welcome everyone to the hidden driver behind investment decisions. And is it coming up? Okay, there we go. I'll just wait a second. Awesome. The delightfully confusing Yogi Berra said, "It's tough to make predictions, especially about the future." And you are so right, Mr. Berra. We are going to talk about some of the fun things that we do with money. Everyone thinks that we make smart, logical decisions with our money, but the truth is we probably don't, at least not all of the time. There is an entire field of study called behavioral finance that shows our brains use the shortcuts that Derek mentioned. They're called biases when we make decisions. And we like to think of these biases as those little brain tricks, and they're normal. Everyone has them, everyone uses them. But these shortcuts can lead us to panic and sell things at the worst time, sell investments at the worst time, chase what's hot, hold on to things that we shouldn't, or feel very confident when we probably also should not feel very confident. There are actually more than 20 common cognitive biases, but don't worry, we're not going to go through all 20 today. We are only going to focus on the 5 that tend to, in fact, impact people the most when it comes to their money. Because once you can spot these biases, you can start to make better decisions. And that's really the goal, not to be perfect, but to be aware. So these are the list of the biases that we are going to cover today. We have loss aversion, recency bias, overconfidence bias, herding bias, and anchoring bias. And we're going to go through each one of these one at a time. We'll go over what each one means, how they show up in real life, and we'll watch a quick video of a client and an advisor in action so you can see how they might actually show up in a conversation about your money and your investments. So the first one is loss aversion. And loss aversion is the idea behind loss aversion is we hate losing money more than we enjoy gaining it. So losing $1,000 feels a lot worse than gaining $1,000 feels good. So some real world examples are home ownership. So for example, a homeowner spends a lot of money fixing up their house, and then later the housing market drops and the house is worth less than it was before. And so even if it might be a smarter decision to sell, the homeowner doesn't want to because they feel they've wasted all of that money and they don't want to waste it. So people keep holding on to things because they've already spent a lot of money on it, even if it no longer makes sense to hold on to it. In career decisions, sometimes people will stay in a job that they don't enjoy because it feels stable or it's what they know. Even if a new job could be happier or pay more, they don't want to risk losing what they already have. Kind of like, I hate my job, but it could be worse kind of mentality. In consumer behavior, we might see something on sale and think, ooh, this is on sale. I better get this. So maybe you buy it, even if you didn't really need it, just to avoid paying full price later, or just because you felt like it was a good deal. My mother-in-law bought all kinds of food because it was on sale. And even if it would expire before she could even use it because she didn't really need it at that time. She just bought it because it was a good deal and it was on sale. Our stock market behavior, we might have someone that buys a stock and then the stock starts to go down. And instead of selling it and moving on, they keep hoping it will come back and they don't want to lock in the loss, even if selling it would actually be the smarter choice. So because of loss aversion bias, people tend to hold on to bad investments way too long, avoid investing altogether, and loss aversion can cause us to think something is more valuable just because we own it. So now we're going to watch a quick video to see the loss aversion bias in action.
I don't care what the market does. I just can't watch my account go down again. In 2022, I lost money. I don't want that to happen ever again. Let's move everything to cash.
That was a rough year. Watching balances drop feels awful. It's not just numbers, it's emotional.
Exactly. I'd rather make nothing than lose anything.
Can I check something with you? If the account goes up $50,000 over the next year, how would that feel?
Well, nice, obviously.
And if it goes down $50,000 for a period of time?
Oh, that would feel 10 times worse than the good feeling.
That reaction is really human. Our brains are wired to feel losses more intensely than gains. The tricky part is, avoiding short-term losses often creates bigger long-term losses, like missing future growth or running out of purchasing power later.
So, you're saying I might be protecting myself emotionally, but hurting myself financially?
That's a great way to put it. My job isn't to make you tough it out. It's to design a plan where market drops don't knock you off course or keep you up at night. We can build guardrails so you don't feel like every dip is a personal disaster.
Excellent. So what can we do about this bias? We can focus on the long-term plan, not short-term drops. We can remind ourselves that markets go up and they go down. That is normal. We can make decisions based on our goals and not fear in the moment. And having an advisor can be super helpful because that's someone who can help calm the fears, and that can be a big help to us. Now we're going to move on to a recency bias. And a recency bias is where we think what has been happening is going to just keep happening. So if the market has been going up, we assume it's going to keep going up. If it just dropped, we think it's going to keep dropping. And so some examples of recency bias are in the courtroom. Some people remember the most recent information more than what they heard earlier. So in a courtroom, jurors may remember the closing argument much better than the opening one because it's the last thing that they heard. And so it can have a bigger impact on their decision. Prosecuting attorneys get to go last in closing arguments because they carry the burden of proof. They're responsible for proving the case beyond a reasonable doubt, so they get the final word. So it's kind of like the last one to talk is the winner, or at least it can kind of feel like that. In performance evaluations, employee performance evaluations, recent events can often outweigh things that happened before, even if it's not really fair that that happens. So an employee has a great year overall, but maybe makes a small mistake right before the review. So the manager focuses on that recent mistake and gives a lower rating, even though most of the year was really, really strong. In investing and financing, you might see this if the market has been going up a lot lately and people assume it will keep going up and invest more money, or if the market just dropped and they may avoid investing even if things have been strong over the long term. So yeah, we sometimes think if it's been going up for 3 months, 6 months, it's going to keep doing that forever. Because of recency bias, people can chase recent winners or sell immediately after a downturn or forget that markets do move in cycles. So let's now see the recency bias in action.
The market has been amazing lately. I think we should put more into tech and growth stocks. This run isn't slowing down.
It's been a strong stretch, no question. What's making you feel confident this pace will continue?
I mean, just look at the last 6 months. Everything keeps going up.
Totally fair. Our brains love patterns. Can I zoom out for a second?
Sure.
Do you remember how people felt at the end of 2021?
Yeah, everyone thought the market only went up.
Right. And then 2022 hit. What we tend to do is assume the most recent chapter is the whole story, even though markets move in cycles.
So I'm kind of assuming the good times are the new normal?
Exactly. It doesn't mean growth is bad. It just means we don't want today's headlines to quietly rewrite your long-term plan. Let's make sure your strategy still works if the next 12 months look very different than the last 6 months.
Excellent. So what can you do if you think you might possibly suffer from recency bias? Zoom out and look at long-term trends. So not just in the last 24 hours, look at last year, last 5 years, last 10 years, and ask yourself, is this a pattern or is this just a moment in time? Because what just happened isn't the whole story. So now we're moving on to overconfidence, our third bias. Overconfidence is where we think we know more than we actually do. I'm sure no one has ever met anyone like this that is overconfident or has ever seen this in action. But some examples of overconfidence bias are our driving skills. Most drivers believe they are safer and more skilled than other drivers on the road. And because of that, they may take more risks, like speeding or not really paying attention. Everyone thinks they're an above average driver, which of course is mathematically not possible for everyone to be above average. In our work performance, people think they can do more or that they know more than they actually can or do. So someone believes that they can finish a project quickly, or understand something fully, but in reality, it takes longer than they thought, or they maybe will miss important details. So someone might think it's only going to take me an hour to get this project done, but 3 hours later, I'm still working on it. And then in medical diagnoses, a doctor might rely on their own experience instead of checking guidelines or new research. And this can sometimes lead to mistakes or missed details in diagnosing a patient, which is scary. Kind of like I've seen this before and famous last words, but they're disregarding any new information that might be available. And then of course in investing, an investor can feel confident that they know what the market will do next. And so they may trade a lot or take big risks or put too much money into just one investment, believing they'll get it right because they can't lose because they know what they're doing. And so because of this, people take bigger risks than they realize, they trade too often or believe that they can time the market, which is really, really hard to do consistently. So let's see how our advisor handles the overconfidence bias.
I've been doing pretty well picking stocks on my own. Honestly, I think I could manage most of this without much help.
You've made some good calls, no doubt about that. Out of curiosity, how do you decide when to sell?
I usually go with my gut. I can tell when something's peaked.
That's impressive confidence. Can I ask, have you tracked how those gut calls compare to the overall market over time?
Not really. I just know I've had some wins.
That's very human. Our brains remember wins much more vividly than quiet losses or missed opportunities. What I worry about isn't intelligence or effort. It's that markets punish even smart people who get a few big calls wrong.
So you're not saying I'm bad at this? Just that confidence doesn't equal consistency?
Exactly. Skill helps, structure protects. My role isn't to replace your instincts. It's to build a system where one wrong call doesn't derail your future.
Excellent. So what can you do if you think there might be an overconfidence bias in play? Build in a second opinion. So pause before making big decisions. Force yourself to wait 24 hours before making a move, a spending, changing in an investment. Ask yourself, what could I be missing? What possibly am I not thinking about? Or what do I not know? And then work with an advisor who can give you an objective view. Confidence is really good, but a reality check is often better. So now we're on to the herding bias, our fourth bias. And so the herding bias is where we follow what everyone else is doing. And so I have 3 words for you: tick, tock, trends. That's a herding bias. Some examples that aren't TikTok of when you might be having been under the influence of a herding bias are in our consumer behavior. People follow the crowd and assume popular means better. So like if you've got 2 examples of, an example is 2 restaurants right next to each other and they look the same, but one is packed and the other is empty. So most people would choose the busy one, even if they don't know if the food is actually better, just because everyone else is there. I've heard my husband say that place must be amazing. Look at the line out the door, but we don't really know if the place is amazing or not. We just think it might be. In adopting new technology, people tend to jump on trends just because everyone else is doing it. A new app becomes really popular, people download it and start using it without really thinking about whether it's useful, but just because their friends are on the same app. And in our financial markets, people invest based on what others are doing instead of thinking it through. So this is the reason why the stock market can act so crazy for often what seems like no real reason. So during the tech boom, people bought stocks in internet companies, even though those companies weren't making any money. And they did it just because everybody else was buying them. Prices went way, way up and then eventually dropped really fast when the reality caught up. If everyone's in the market making money, I should get in too. And that usually is what we do right before it drops. Herding can make you feel safe because you're not alone, because it's crowded. But investing, if you're following the crowd, that often means you're probably already late to the party. And because of this, people jump into trends too late, buy things when they're already expensive, or make decisions based on noise instead of a plan. So let's see the herding bias in action.
Everyone at work is moving into gold and crypto right now. I feel like I'm missing out if I don't do the same thing.
It's uncomfortable feeling like you're the only one not doing something. What are you hoping gold and crypto will do for you?
Honestly, I don't want to be the only one who didn't get in early.
That fear of being left behind is powerful. Let me ask, when everyone around you is rushing towards something, do you usually feel calmer or more pressured?
More pressured.
That pressure is a signal. Big crowd moves often happen after the early gains, not before. We can absolutely explore those assets. But I want the decision to come from your plan, not your break room.
So you're saying everyone's doing it isn't actually a strategy?
Exactly. Popular doesn't always mean profitable.
So what can you do if you might be experiencing herding bias? You can have a clear plan before the noise starts. So you don't need that hot stock because you already have a plan in place and you're working the plan. Don't make decisions based on headlines or hype or TikTok videos. Stay off of those social medias and remember that most reels or videos are not actually for education, but they are advertisement. And if everyone is talking about it, it's probably already too late. Then the last one we have is anchoring. And anchoring is where we get stuck on a number, even if that number doesn't matter or isn't relevant anymore. The first number we see sticks in our head and it affects what we might consider a good deal. So in consumer behavior, we might see this where we're shopping for a home and the first price you see can shape what you think is a reasonable price. Even if other homes are better or worse, that first number sticks in your mind and influences what you're willing to pay. So this happened to my husband and I when we bought our first house. This was way back in the late 1900s. And my husband and I were looking at houses and we had a tough time pulling the trigger and making an offer on a $100,000 house. Like right now, we'd be like, yes, please, I will buy that. But we took so long to decide that it sold before we even could get our offer in. Then the next day, literally the next day, we looked at another house and that house was $110,000. And we had no problem acting quickly and putting an offer in on that one because the first $100,000 house was a lot for our brain to take in. But then the next one was so much easier because we had already adjusted our brains. Our brains had adjusted to the $100,000 price. And so that was our new anchor point. First impressions can have anchoring bias. The first thing that we hear about someone affects how we see everything later after that for that person. So if someone tells you that someone they know is difficult or someone that you're about to meet is difficult, you may start noticing only the things that confirm that, even if they're actually quite easy to work with. You don't even notice that. And then in financial markets, people can get stuck on what they paid for an investment, even if that doesn't matter anymore. Someone buys a stock at $100, it drops to 70, and that person says, I'll sell it when it gets back to 100. But the market does not care at all what you paid for it. And the decision should be based on what makes sense now, not something in the past. So because of anchoring bias, people will hold on to investments and waiting for them to break even. And they may make decisions based on past prices instead of the current reality. So let's see our cartoon advisor handle the anchoring bias.
I'm not selling that stock until it gets back to 150. That's what I paid for it.
Got it. So 150 is the number that feels right to you.
Yeah, selling before that just feels like admitting I was wrong.
Totally understandable. Let me ask something gently. If you didn't already own this stock, would you buy it today at its current price?
Honestly, probably not.
That's really helpful insight. Right now, that $150 number is acting like a mental anchor, even though the market doesn't know or care what price you paid.
So I'm letting the past price decide my future move?
Exactly. The more useful question is, given what we know today, is this still the best place for this money going forward?
Excellent. So what can you do if you think anchoring is creating some issues for you or holding you back? So focus on today's reality, not the past numbers. Ask yourself, would I buy this today if I didn't already own it? And definitely remember, the market does not care what you paid for it in the past. So none of these make you bad with money. They make you human. And so we're going to take a quick poll and see which of these biases you might relate to and have experienced. So go ahead and take a second to fill out the poll, and you can pick one, you can pick more than one. Maybe it's all of them. I know for me, it's all of them. Excellent. Getting some numbers. It looks like loss aversion, recency. Wow, loss aversion is really high. That's awesome.
Anchoring sticks out to me the most. All the
I feel
time,
like
I want
anchoring,
something and then I
I
don't want to
know,
buy it, and then I
I
go
know.
get something, food with
Yep.
everything.
I know. And I feel like once you've seen something on sale, then you have a hard time. I call it like the Kohl's effect. Like
Mhm.
no one, or the half price store effect, like no one will pay full price at Kohl's because there's always a 10%, a 20%, a 30% coupon. And so
Yep.
now you've anchored that in order to go into Kohl's, if I'm buying anything, I better have a coupon. And that's,
Yep.
to me, that's anchoring too. That's definitely common for sure. Excellent. All right. Thank you everyone for participating in our highly scientific poll. So I am excited for what's up next. Seth is going to walk us through how to put guardrails in places so that you don't have to just hope that you don't succumb to these potentially costly biases, because awareness is step one, but having a plan that you can stick to really makes the difference. Seth, I'm handing it over to you.
Thank you, Penny, and a happy tax day to those who celebrate. Behavioral finance and science has found that as humans evolved, our brains developed two distinct operating modes: fast thinking and slow thinking. Fast thinking is reflexive and instinctive. Acting quickly on pattern recognition helped our earliest ancestors avoid being eaten by larger predators. And it's important to pay attention to these gut instincts for survival. The cognitive biases that Penny just presented are examples of fast thinking. Slow thinking, by contrast, is more long-term and strategic. Important financial decisions with lifelong consequences are best approached in this mode. Slide, please, Derek. All right. So most of us have long-term financial goals. These may include retirement, educational funding, charitable giving, and leaving a legacy to your family, or all of the above. Your goals may extend to multiple generations. Inflation is the single biggest challenge to meet long-term goals. Even modest inflation of, say, 2.5% will erode purchasing power over a lifetime. For example, in 1920, a gallon of milk cost about 17 cents. Excuse me, a quart of milk. 100 years later, that 17 cents bought just 11 tablespoons. So now that we have covered milk, let's turn to the eat your veggies part of the presentation. I'll review some key investment principles from an evidence-based approach, and hopefully these will help you focus on the bigger picture when those cognitive biases come calling. So investment principle number one, let markets work for you. Markets have rewarded long-term investors and provided growth of wealth that has more than offset inflation. Safe assets like treasury bills have barely exceeded inflation, and there have even been periods when they failed to keep up with inflation. Longer term bonds have done a better job, but most of us need some consistent exposure to stocks in order to grow wealth significantly that outpaces inflation. Number 2, accept market prices. The market acts as a giant information processing machine. World equity markets bring together buyers and sellers to process billions of dollars in trades each day. The real information that they bring helps set prices. That's a lot of pricing power to bet against, and that's why it's best to accept current prices. This is a different type of AI, call it aggregate intelligence. Principle 3, don't try and outguess the market. The market's pricing power works against stock pickers and market timers. At the beginning of 2004, there were about 2,800 equity mutual funds in the US. Over the following 20-year period, ending 2023, only 45% of them were still in business, and only 18% beat their benchmarks over the entire period. As you can see, the story is not much better for bond funds, with only 49% survival rate. And consider that these are the results for the professionals. Principle 4, practice smart diversification. US stocks make up about 65% of the total world market. Over the last several years, domestic companies, particularly the Magnificent Seven, have delivered really strong returns. 2025 was no exception. The market returned about 18%, but the US didn't even rank in the top 30 in terms of best returns. Developed and emerging market international indices had returns of over 30%. So I think we've got our second poll question here, which I've already answered before the poll. So if you don't all get this right, we're in trouble. The top performing country in 2025 was Colombia, with a market return of more than 97%. Not too long ago, during the period between 2000 and 2009, we experienced the lost decade when the S&P index had a slightly negative return. Holding a globally diversified portfolio broadens your opportunities to capture higher returns wherever they show up. Principle 5, avoid market timing. There's no reliable way to consistently time the market. Staying invested helps ensure you're in a position to capture long-term returns. If you missed the best 6-month period over the 25 years ended last year, the value of your investments would have been 35% lower than had you stayed invested. Don't leave returns that you deserve on the table. Principle number 6, manage your emotions. Markets can be very volatile, and it's hard to control our emotions when we see wide fluctuations in account values. Reacting to current market conditions with behavioral biases can lead to poor investment decisions with long-term consequences. Principle 7, look beyond the headlines. News and market commentary is going to challenge our long-term investment discipline. The financial press is in the business of attracting attention to sell advertising, and they know how to appeal to our worst instincts because that's what sells. Do yourself a favor: when events make you unsettled, take a deep breath, tune out the noise, and work with your financial advisor to stay focused on the big picture. Principle number 8, focus on what you can control. While you can't control short-term market fluctuations, you can focus on things within your control. Create a long-term plan. Structure your portfolio appropriately. Diversify globally. Manage expenses, turnover, and taxes. Stay disciplined and tune out the noise.
Seth, Penny, excellent job. It's funny when Penny's going through all those biases. I feel in my career I do a great job of avoiding them, and in my personal life, I do a terrible job avoiding them. So, good reminder. Always room to improve. So now it looks like we do have some time to get to some questions. So again, please, if you have any questions, please put them in the Q&A box below, and I will see what we are working with here. Give me a second. First question, let's see here. How do I know if I'm making a smart decision or just reacting emotionally?
That's a good question. Because we've probably made everybody really nervous now. They're gonna like doubt themselves that they're suffering from a bias. So usually a good decision feels really calm and thought out, and it doesn't feel urgent typically. So if you're feeling like you need to act right now, or you need to do this by this time or by tomorrow, then that's probably maybe not. That's probably a signal that you're being emotional. And before you act, you could ask yourself some questions like, would I make this decision if the market wasn't doing what it's doing today? Um, is this part of my long-term plan? And if the answer is no, it's probably emotion talking, probably. And this is also where it can help to talk through with somebody, hopefully somebody who knows something about your money, but isn't emotionally tied to your money. Because if you talk to someone else, like a spouse who's emotionally attached to the same money, that might also create emotions in that person. And so a third party, a financial advisor, a trusted person can sometimes show you another perspective or help you kind of reduce those emotions and bring some of the emotion down.
Yep.
If it feels rushed, pause. Good decisions usually will wait. Good choices.
Yep, very well put. Here's a good one. Is it okay to make changes to my investments, or should I just leave everything alone? Interesting question.
I love that. That's yeah, no, yeah. Is it okay to make changes? That's yeah. Hopefully, we haven't made people that nervous. So,
Well, I think it's
um,
important first. You have to define changes, right? Should you
well,
make
that's true.
full sweeping changes across your entire portfolio? That's a very rare thing that, I mean, I can't think of a time we've ever done that, frankly,
Yeah,
because I
right.
think what's Eugene Fama say, after what, 50 plus years, they've come up with only a few principles that
Yeah.
generate returns.
Um, yeah, I think it's yeah, I just it is a good question because sometimes changes are the right thing to do. And it seems like just logically that never changing anything seems like a dumb idea. It just seems like that doesn't even make sense. And I'm, going to give the whole our regular financial advisor speak, which is it all depends, right? Like we love to say it all depends because it does depend. And so it depends on life changes, retirement. Do you have a new goal now and things are changing? Has something changed in your life? A job loss, taking care of elderly parents, you've had a child move out. Those things, that's when I think change is thoughtful and appropriate. But if you're seeing a TikTok video or looking at a headline or talking to your uncle who's broke, your broke uncle, that maybe is a feeling, and that's kind of where we want to pause too. So yeah, good rule of thumb is changes should come from your plan and not from panic.
Yep, and if you're going to make more consistent changes, they should be based on rules. Like, I guess technically rebalance is making changes to the portfolio,
Mhm.
but you're following a strict set of predetermined rules, which should always be in place when it comes to managing your money.
And it's intentional. It's yeah.
Exactly. Let's see here. How do advisors make sure they don't fall victim to biases while working with clients' money?
Excellent question. I think we're all human, and we all feel the impact of steep market drops and all of the things going on around us. But you have to step back, take a deep breath, and make sure that what you're doing is in line with the financial plan that you've laid out for your client, and does it fit with the plan? That's the most important thing, because we're in the business of meeting long-term client objectives.
Yep, very well put. Let's see here. Next question. This is a good one too. How to create a balanced portfolio when the existing portfolio contains securities with very high capital gain liabilities. This is a tricky one because it's very specific to that
Yeah.
individual person, right? If your entire portfolio is comprised of just these highly appreciated stock, it makes it harder. There's really, really complicated things you can do using leverage, but for most people, those don't make a lot of sense. So that's a difficult question to answer because it really is specific to the client. Whereas a client, if you have some money in a brokerage account with, high appreciation, but you have money in an IRA, maybe you under allocate money towards whatever that asset class is in your IRA that's overweighted. So, I mean, it's kind of a scapegoat answer, right? There
Yeah.
are usually ways you can navigate. I mean, there's always ways you can navigate it. It's just the level of complexity you want to use really depends on the situation.
Yeah, and I think this kind of comes down to again, like kind of some of the things we were talking about, which when I'm talking to clients, I hear them worry about taxes a lot. And to me, I feel like that is they're seeing ads for different products and for different firms that are going to help them with their taxes. And they see a lot of things that are scaring them about taxes, and taxes are the boogeyman. And like no one likes paying it. But we've all paid it our whole life. But when we're seeing those recent things, that recency bias is coming in because I'm seeing all these things on TikTok or, even on television talking about taxes, and I might be messing it up and I'm going to lose half of my retirement to taxes. And it gets us afraid. So there's that. And then sometimes I found that when number one, capital gains tax is like one of the lowest taxes that we can pay. So that's a good thing. Two, you've made money. That's also a good thing versus losing money when you get a deduction. We're not as excited about that. And also, I just think that, when I've actually done the numbers and been like, okay, you're paying $300 in capital, like it's usually not as bad as what they think it's going to be. Typically, I
Mhm.
find that most of the time they're very nervous about it and concerned about it, but actually in dollars, it's actually not life-changing money. That's been my typical experience with clients.
Yep.
I think
Paying.
we've got a number of strategies at Apella, including unified managed accounts and charitable giving vehicles that can help reduce some of the tax impact of concentrated positions. So talk to your advisor.
Yes. And in honor of National Tax Day, paying capital gains taxes is a wonderful thing, right? It means you did nothing and made a lot of money. So,
Right.
the more
Literally
capital
what we're
gains,
trying to do when we invest our
yes,
money is
the
gain,
more the
get
more
more
the
money.
better. The more the better in some ways. Let's see here. Can you address how older/retired people should think about changing strategy, especially for people whose long term won't be more than 10 or 15 years because we all only live for so long?
But I think you need to make incremental change over your investment lifetime as that room for error with volatility. I used a jargon word, Penny. I'm sorry. Variations in value becomes narrower. You need to lean more into stable value assets like bonds, and reduce your stock exposure. There's no way around it. And sometimes that has tax implications. But if you need those values to last, in order to fund your expenses, that's really the only approach that works.
No, it's a great answer, and it's a funny question because it really touches on a lot of the different biases. I mean, the main reason people sometimes hesitate to get into more fixed income, even though it might be appropriate for them, is years like last year where the market goes up. Naturally, usually when you have an higher allocation towards fixed income, it is in theory going to reduce your return a bit. So during the good years, it's not as fun. But at the same time, during years where the market goes down, it makes a really, really substantial difference. And, minimizing losses in down years is equally, if not more important than, trying to make gains in good years. So that's a really good answer, Seth.
Well, and I like to talk it over with clients too. Like you don't need all of your money day one of retirement. Some of that needs to be invested for, 70-year-old you and 80-year-old you and probably 90-year-old you. And so that also is something to think about. I don't like so that people don't think they need to move all the cash or put it somewhere safe as well, is to kind of keep that in perspective, that because it does when it can be challenging to go from building up this account to now looking at slowing down the growth, and also because as you move into more fixed income, and then also when it comes time to start spending it down, that can be challenging as well.
Couple more. Let's see here. What mistakes do you see investors make repeatedly, even when they know better or don't know better? They're making the mistakes.
So I think that as a profession, we have a tough job with assessing risk preference. I used a jargon word again, Penny, sorry. I think when you look at a slide and your advisor asks you, how are you going to feel if you lose 30% of the value of your portfolio? It's very different looking at that slide and then actually experiencing the 30% loss. And I think over time, we all come to the right place in terms of how much risk we can tolerate. But maybe we should be asking people at the moment of that 30% loss, how much can they tolerate? Because that's when the roost, that's when things really come home to roost.
Yep. I also think, recency and hurting is a big one too. And I think the last 5 or 6 years are a good, they're kind of indicative of that because if you look at the market the last 6 years, I mean, 2020 to 2024, the US stock market was absolutely on fire, except for 2022, it did incredibly well. So you hear from a lot of clients, we want to be in more US stocks, right? Domestic stocks are the best. And then you look at 25 and 26, the last, 18 months here, and international stocks and emerging market stocks are doing many, many multiples better than the US market. So that's why it's important to, I think Penny said earlier, said, tune out the noise, create a portfolio, create a plan, and stick with it through good times and bad, even though it can at times be very difficult. So we got one more question here. Did I already ask that one? What should I do in the moment when the market is dropping and I feel like I need to do something? Turn the TV off. Walk away.
Yeah, right. Yeah. Yeah, stay inside. No. Well, this is really challenging. And this is one of those, like Seth said, where it's like, it's easy to think about what I'm going to do when the market is good, but what I'll do when the market is bad, right? So it's good today. I'm going to think about, oh, I'm good. I'm a risk taker. I can handle it. And then when it actually hits, what is that Mike Tyson quote? Everybody has a plan until they get hit in the mouth. Is that how that goes? And so, you got the plan that you're going to stick it out, and then you get hit in the mouth by a 30% drop, and all of a sudden you are upset. And so the answer is always going to be pause. Like anytime you start to freak out, the answer is always going to be pause. You don't have to make a decision right away. In fact, usually bad decisions are the ones that are coming quickly. Usually a quick decision is a bad one, typically. Or most bad decisions happened quickly. Has the long-term plan changed? What has really changed? Is this just hype? Is this just some channel trying to get us to tune in later because they've made us afraid, or clickbait on the internet? I see that all the time. It's astonishing, kind of scary actually. And like I said, has my long-term plan changed? And if no, then probably the best move is to stay the course. And we keep saying it, but call your advisor if you have an advisor.
Yeah, I think that's the big part right there is when you react quickly to something, it usually means you're reacting emotionally rather than logically. And, one of the benefits of an advisor is we don't have any real emotional attachment to money that we manage. So that gives us the ability to react, logically and appropriately rather than being worried and, reacting emotionally. And again, emotional reactions are usually not a great thing.
They're human, but they're not great ways to make decisions.
And this last quarter and the beginning of the year has given us sort of a master class in volatility already. But the market is incredibly resilient, and we've made up most of the losses already. It's
I mean, between COVID and 2020, tariffs last year, extreme volatility. You hear from a lot of clients that, in the heat of the moment, they want to reduce aggression of their portfolio, go to cash. That's why it's important to not do that. Because as you could see last year and in 2020, the market ended up, for reasons unknown to many, turning around. Awesome. Well, one more moment if there are any other questions. But if not, thank you everybody very much for joining us. And thank you, Seth and Penny, for doing an excellent job explaining the different biases in investments. So, like I mentioned earlier, this has been recorded. We will send it out, I would guess, in the next week or two, and it will go up on the Apella Wealth website under the events tab. And then also our next webinar is May 20th, and we will be covering estate planning, which is very, very important. So I would highly recommend signing up for that. So again, thank you, everybody. Thank you, Seth. Thank you, Penny, and everyone have a great day.
Thank you, Derek.
Thanks, Derek. Thanks, Seth, for
Thank
all
you,
your
Derek.
work.